Welcome back. You're with us on Editors Roundtable, and we've been discussing, of course, the consolidation in the local market, the slight revival in the mid-cap arena. But the biggest global story of this week really has been the non-stop rally in the Chinese markets, and more specifically in the Hong Kong Hang Seng, even more than the mainland Chinese market. So what's really going on? Let's, put the spotlight on this. Now, the Friday moves first up. This was Friday. A lot of Asian markets were flat to slightly, negative or very mild gains. But look at the Hang Seng, 3%. Actually, by the time it ended, the market closed out. This was an intraday market trade that I took. It was almost a 4% move on the Hang Seng. The Nikkei is slightly higher. The Kospi was flat, and the Nifty, we ended down about 0.5%. But it's not a Friday story at all. This story has been in the making since the start of 2025. Look at the huge disparity in the distinction between the Hang Seng, which is up almost 19%, and the Nifty, which is down 4% so far this year. Let's go a little deeper. Like I said, this is more a Hong Kong Hang Seng story right now than a mainland Chinese equity story. So the Hang Seng, like we said, is up about 18.5%, 19%. The mainland indices, the Shanghai Composite in 2025, about 3.3%. The CSI 300 index, about 3.8%. So what's happening with the Hong Kong index? Actually, even if you dive in a little deeper, you'll realize it's the Hang Seng Tech Index that's really caught the investors' imagination. The index is up about 34% so far in 2025. But I tell you what, this is not a story that's just started this year. It's been in the making for the past 6 months or so. Because if you look at the last 1 year gain of the Hang Seng Tech Index, it's almost 70%. What has this index done? It peaked out in Jan 2021 when all the noise around tech entrepreneurs started in China. The peak was 10,300 almost. It crashed to a low of 2,720. And now the recovery, it's a very, very impressive recovery. It's come back to a level of about 5,800, which means the index has doubled from the peak. I mean, the increase is almost 111% from the low, that is. So let's move on and talk about what are the factors that are leading to this. Couple of factors. Number one, DeepSeek. The world is absolutely enchanted with this low-cost AI model that the Chinese are able to make. Then it's not just DeepSeek. There's recovery in Chinese tech earnings as well. Look at Alibaba's numbers. The stock was up 15% in mainland in the Chinese trading on Friday, 8% on Wall Street trading. And it's not just Alibaba. Even stocks like Lenovo have outperformed expectations this quarter. Then, of course, the big event was the Chinese president's meeting with the industry leaders and entrepreneurs. And the fact that Mr. Jack Ma was present in this meeting, that has really, sent a very, very positive signal out there. What did the Chinese president say? Mr. Xi Jinping is now saying that he wants a very open and fair sort of relationship with Chinese industry. No arbitrary seizures or no sudden inspections, which is what we remember, which is what happened immediately after COVID, which is where the big tech crackdown was happening earlier. That seems to be now changing, and there seems to be an olive branch that the government is giving out. Last but not the least, obviously, valuations. Look at China valuations. MSCI China is trading at about 11, 12 times one-year forward earnings. MSCI India is still trading at almost 20 times. So there's a very clear valuation difference. The question is this the real deal? Or is this another flash in the pan trading tactical rally in China? This is the Hang Seng chart of the last 1 year. The thing is, we've heard this before. We've seen this before. In May, there was a bit of a trading fillip that came through because of stimulus measures. Again, in September, there was a big rally. We thought this is the big China stimulus, but it fizzled out. And now this is the third wave going up. Just to jog your memory, a lot of stimulus measures have been announced by China in the last 1 year, starting with monetary measures. They cut the reserve ratio requirements. They cut the reverse repurchase rate as well. Then there were measures for the property market, and there were measures for the equity market. Some of them were very interesting, easier buybacks, getting a lot of the index funds and ETFs to invest more money, telling Chinese local mutual funds and insurance companies to increase their holding of local stocks. So all this has happened, but the rallies have fizzled out, which is why I'm asking, is this the real deal? Because now you have the tech companies moving higher and all the past 1 year stimulus. So will the dragon really start firing again? Because if that happens, Indian investors will watch very, very carefully, and they will wonder whether this further complicates the issue for us with respect to FPI flows. And that's really the question I want to put to Mihir. Mihir, we were talking about market ownership, and of course, it's domestic investors here. We own the market here. But FPI selling has really broken the markets back. Now, I don't know about selling or not. The fact is, with China doing what it's doing right now, if this continues, do all